A card touches a terminal. The screen says, approved. The customer walks away with coffee, fuel, medicine, or a train ticket. But in that tiny pause, no money has actually moved into the merchant's account. What has happened is stranger. A chain of machines has made a temporary promise. The terminal asked a question, several institutions judged the risk, and one bank accepted responsibility if the transaction survives the next steps. That green checkmark is not the end of payment. It is permission for the real payment to begin. Hiddenova follows one ordinary tap from the counter to the banking system. The first conflict begins at the terminal because the merchant needs a decision before the customer leaves, while the banks need enough evidence to avoid fraud, errors, and unpaid debt. Those two needs collide in seconds. The payment cannot wait for a full accounting cycle, yet it cannot be accepted blindly. So the system breaks the purchase into stages: capture the payment data, route the request, score the danger, authorize a hold, and later settle the money. Each stage exists because the previous one is not enough. The journey starts with the object in the customer's hand. The card tap is not a simple broadcast of money. It is the creation of a payment message. A contactless card or mobile wallet communicates with the point-of-sale terminal at very short range. The terminal collects the information needed to describe the purchase: the amount, the merchant, the time, the payment method, and security data proving that this is not just a copied number typed into a form. In chip and contactless payments, the card can generate transaction-specific data, often called a cryptogram, which helps the receiving systems decide whether the payment credentials are genuine. This first moment matters because the terminal is not trying to move funds directly. It is trying to prepare a question that can survive scrutiny. Should this merchant be allowed to place this charge against this customer's account right now? If the message is incomplete, malformed, or unsupported, the journey can fail before it reaches a bank. But if the terminal builds a valid request, the next problem appears immediately. The merchant usually does not have a direct line to the customer's bank. Most merchants do not send authorization requests straight to every card-issuing bank in the world. They connect through a merchant acquirer or payment processor. The acquirer is the institution or service provider that accepts card transactions on the merchant's behalf and forwards them into the card payment system. This layer exists because merchants need a single operational doorway, not thousands of separate banking connections. The acquirer checks whether the merchant is recognized, whether the transaction format is acceptable, and where the request should go next. If the merchant account has a problem, or if the terminal is not configured correctly, the payment can stop here. The consequence is immediate. The customer sees a decline or an error, even though their own bank may never have been asked. When the request passes this checkpoint, the acquirer routes it outward. Now the decision moves from the store side of the transaction to the network that can identify the card's issuing institution. A card network is the routing and rules layer that connects acquirers with issuers. The issuer is the bank or financial institution that provided the card or account to the customer. The network reads the payment message and determines where the request must go. It also applies technical rules so that different terminals, processors, wallets, and banks can understand one another. Without this standardization, a card issued in one place might fail in another simply because the systems speak different languages. But routing is not passive. The network can help enforce rules around transaction type, card capability, and message integrity before the issuer makes the final authorization decision. The pressure is time. The customer is waiting at the counter, the merchant wants certainty, and the issuer needs context. The network's task is to move the request quickly and accurately to the institution that can answer the central question. Can this account support this payment, and does the transaction look legitimate? At the issuer, the transaction becomes a judgment call. The bank checks whether the account is open, whether the card is active, whether the available credit or funds can cover the amount, and whether the transaction fits the issuer's fraud controls. Fraud checks may compare the purchase with recent activity, location signals, merchant type, spending patterns, and the security data included in the request. The point is not to prove a transaction is good with perfect certainty. The point is to decide whether approving it creates an acceptable risk. A legitimate customer can be declined if the system sees too much danger. A suspicious transaction can be blocked before the merchant releases goods. And a normal transaction can be approved because the account, the credentials, and the risk signals line up well enough. This is the most consequential second in the chain. The issuer is not handing cash to the merchant. It is sending back a decision, approved or declined, sometimes with a reason code. If the answer is yes, the promise travels back the same route. When the approval returns to the terminal, the customer sees the result as a green light, a beep, or a printed receipt. To the customer, the purchase feels complete. To the payment system, it has entered a pending state. The issuer may place an authorization hold on the account, reducing available funds or available credit by the purchase amount. This prevents the same money or credit line from being spent as if the transaction had never happened. For the merchant, the approval is evidence that the issuer has accepted the transaction under the card network's rules, assuming the merchant later submits it correctly. This pending state is why banking apps can show a card purchase before it has fully settled. It also explains why the amount can sometimes change in certain transaction types, such as when a final total is captured after authorization. The approval solves the problem at the counter. The merchant can release the product or service, but it creates a new obligation. The merchant must now capture and submit the approved transaction for clearing. After the sale, the transaction must be converted from a real-time decision into a financial instruction. Merchants typically send captured transactions to their acquirer, often in batches. This is the clearing stage. Transaction details are organized and passed through the network, so issuers know what needs to be posted to cardholder accounts, and acquirers know what merchants should receive. Clearing matters because an authorization by itself is not the final bookkeeping record. The captured transaction must match the approved purchase closely enough to be accepted. If details are missing, late, duplicated, or inconsistent, the transaction can create disputes, reversals, or processing problems. This stage also carries fees and rules that determine how the payment is classified between institutions. The green checkmark at the terminal was a fast answer under pressure. Clearing is the slower administrative process that turns millions of fast answers into records that banks can reconcile. But even after clearing, the merchant still needs the one thing the customer assumed had already happened: actual funds moving between financial institutions. Settlement is the stage where the financial obligations created by approvals and clearing are resolved between institutions. The issuer owes money into the system for approved and cleared cardholder purchases. The acquirer receives funds so it can pay the merchant, usually after subtracting applicable fees or adjustments. The exact timing can vary by market, institution, payment type, and merchant arrangement, but the principle is consistent. Settlement is when the promise made during authorization becomes an interbank movement of value. This separation between approval and settlement is not accidental. It allows a customer to get an immediate answer at the point of sale, while banks perform the heavier reconciliation work later. It also creates space for reversals, refunds, chargebacks, and corrections when something goes wrong. The card tap looks instant because the system gives the customer a decision quickly. The payment becomes complete only after the later machinery catches up. And that delayed completion is the reason the system can be both fast at the counter and controlled behind it. The card approval is powerful because it separates certainty from completion. At the counter, the system cannot wait for every ledger to settle, so it produces a controlled promise. The issuer accepts the risk, the merchant releases the sale, and the customer moves on. Later, clearing and settlement turn that promise into accounting reality. This design is the reason a 2-second tap can support global commerce without pretending that money teleports. The most important technology in the moment is not speed alone. It is the ability to decide under pressure which promises are safe enough to make. If this changed how you see a simple card tap, comment with the part that surprised you most, like the video, and subscribe for more Hiddenova documentaries on the systems behind everyday life.